I am AI Avatar of C. Ratan Mundra. The India-US trade deal has sparked optimism in financial markets. The rupee strengthened shortly after the announcement. But the real question is, can this deal alone stop the rupee's broader weakening trend? The short answer is, it helps, but it is not powerful enough on its own. In the days following the trade deal announcement, the rupee appreciated by around 1.75%. Markets responded positively. Sentiment improved. However, short-term currency reactions driven by news are very different from long-term currency stability, and that depends largely on foreign capital flows. This is currently a framework-level interim agreement forming the foundation for a broader bilateral trade agreement between India and the United States. The deal emphasizes expanded technology trade, supply chain cooperation, and economic alignment. But the operational details, tariffs, quotas, compliance standards will ultimately determine its real economic impact. To understand whether the deal can arrest the rupee's fall, we must examine the real drivers of USD INR. First, the trade balance, exports versus imports. Second, capital flows, foreign portfolio and direct investments. Third, oil prices and a current account deficit. These structural forces move the rupee far more than headlines. Lower tariffs and clearer market access can support Indian exports to the United States. This reduces policy uncertainty and improves investor confidence. However, if India simultaneously increases imports, especially in energy, defense, or technology, the short-term trade balance effect may be neutral or even negative. Capital flows are the most powerful driver of the rupee. If the deal attracts sustained foreign portfolio and direct investment inflows, the rupee stabilizes. But if global investors turn risk-averse or US yields rise sharply, dollars can exit emerging markets, weakening the rupee regardless of bilateral agreements. India's structural dollar demand is heavily influenced by crude oil imports. If global oil prices rise, India's current account deficit widens. That increases dollar demand, putting downward pressure on the rupee, even if trade relations improve. Headline announcements create excitement, but currencies react to execution. The fine print matters. Rules of origin, which products are actually covered, how quickly changes are implemented, and whether enforcement is consistent. Without clarity in these areas, the rupee's structural direction will not fundamentally change. Export-oriented manufacturers may benefit from improved market access. Engineering and industrial sectors could gain from reduced trade friction. Capital markets may also see renewed offshore allocations if investor confidence improves. Sensitive sectors such as agriculture and dairy may face competitive pressures. Domestic stakeholders could resist rapid liberalization. Any delay, protest, or renegotiation increases policy uncertainty, which currency markets price very quickly. The most realistic scenario is stabilization. The deal reduces volatility and improves sentiment. But sustained appreciation requires durable foreign inflows. If foreign inflows accelerate, crude remains stable, and implementation clarity improves, the rupee could strengthen more meaningfully. But this requires multiple favorable conditions aligning simultaneously. If global markets turn risk-averse, oil prices rise, or domestic resistance delays implementation, the rupee could resume depreciation. In this scenario, the trade deal becomes a temporary sentiment boost rather than a structural anchor. For practical decision-making, track 5 indicators weekly: foreign portfolio flows, crude oil prices and current account data, RBI reserve trends and global dollar strength. If these align positively, the trade deal can support durable stabilization. The India-US trade deal is a meaningful positive development. It reduces uncertainty and improves sentiment. But it cannot single-handedly arrest the rupee's fall. Sustained stabilization depends on capital flows, oil dynamics, and macro fundamentals, not just trade headlines. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup. Operational support and handling compliances, risk management renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BATF, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.